Hello, I'm Jamie Eppenberg, your host today and a member of the Carl team. We're chatting today with Tim Rawlins from Quant Infinity Solutions AG, and we're going to find out what makes the fund so successful, the history, and honestly, what's important to know about this fund if you're thinking of investing. This is a new fund on the Carl platform. And before we dive in any further with Tim, I do want to say we've got quite a few funds coming up. Some of them have posted, like Churfirsten here, which I'm pronouncing terribly, and Tim will do just such a tremendously better job. But we've got a couple more coming up. So stay tuned to the app, stay tuned to podcast updates. We will get you all the information. This is a first chat about the fund, so we try to get you the basics. We are Carl. We digitally offer quantitative hedge fund strategies as a fund of funds, packaged and data delivery for accredited investors. Carl is offering Churfirsten which is based on Quant Infinity Solutions ART or ART strategy, and that is their adjusted risk technology strategy. So we're based on ART today. Oh, that's exciting. But our fund today is Churfirsten. We're chatting with Tim. Tim Rawlins is the head of quantitative products at QISAG. That is a Swiss fintech company, which consists of, here, wait for it, mathematicians, physicists, aircraft engineers, computer scientists, and financial industry experts. They wanted all the smarty pants because their purpose is to democratize technologically enhanced investment strategies and offer unbiased, data-driven solutions to their clients. And as you know, Carl loves a little unbiased, data-driven solution. So we've obviously partnered up with them to offer this solution. Hi, Tim. It is great to be chatting today. How are you?
Yeah, happy to be here, Jamie. Well,
great. Where are you actually today? Are you in?
I'm in London.
Okay. I didn't know if you were in the Swiss Alps or something. It might be a little more exciting.
I wish.
Don't we all? All right. So we generally kick off with this first question, which is can you pronounce this for us so that they know that I'm butchering it one more time. Churfirsten. Okay. I will do mine.
I'm doing it right.
Now I have him wondering. It's got to be better than mine. So let us know what Churfirsten, what has made the strategy that Churfirsten is based on. What has made that strategy successful so far? And why would you keep it in your portfolio if you weren't managing it?
Well, our strategy is based on the assembling of multiple uncorrelated trading algorithms. So we don't have one source of information for our trades, right? So we use a whole set of different algorithms that are programmed to detect different market characteristics and profit off them. So technically, we actually have our main goal is to develop as many uncorrelated trading algorithms as we possibly can, right, on a diverse set of instruments. And then we actually keep certain of them live trading in the model. We keep some of them outside of the model on standby. And we constantly renew the algorithms and the models that are being used live. So as the markets evolve, so do our systems in a way. So we tend to, let's say, kick out the worst performing models in a quarter.
Got it.
Put back in the ones that on standby were performing quite well, right? And then all of them tend to uncorrelate with each other. And we try and find the ones that would give us the most uncorrelated sources of return, right? So
if I'm hearing you correctly, actually, it's a strategy that isn't one strategy. It's looking for the best strategy that's working in given the current market conditions. So if a strategy is not being very effective, then you will maybe swap it out. Is that what I heard?
Yeah, I mean, it's actually a little bit more complicated than that.
It always is. I know.
So it already is a set of different strategies or models, let's say, and we would assemble the signals that are given by all of these models. So we would typically include, so if let's say on a 1 minute, let's say now some of them are saying buy 50 more units, right? Another one is
Right.
saying sell 20. We would, let's say, buy 30, right? So we
Got it.
consider the algorithm. Each algorithm, we consider the inputs that it gives us.
So it's like a package of algorithms, but then you're also always changing the package.
Exactly, changing the package to reflect current market conditions. Yeah.
Interesting. And what's the universe? What's the trading universe we're in here?
We have futures contracts, 60 plus futures contracts. This is equity, fixed income, FX, metals, energy, you name it.
Interesting.
Traded.
Okay.
Well, this is why we typically look for uncorrelated instruments as well, right? So that we can build algorithms, let's say, that would not be the same as the ones that you would typically build on one future contract, right? You would build another one on a different future contract because you would search for different market characteristics there.
So in general, we consider, Carl strategies are usually uncorrelated in and of themselves, but you're saying the strategy works to stay uncorrelated with itself even, so that your diversification is well played.
Exactly. And then it just becomes a question of managing the risk properly, right?
Right. We'll talk more about that. So as the Churfirsten manager, obviously you really care about data and making sure that you're getting the best data in, and that your algorithms, you're, reviewing them in the proper frequency, whatever that may be. What was this the plan? Was this how the strategy was structured from the very beginning? I can't remember how long this one has been running, but is this how it has always been running, or have you guys made any adjustments over the time that ART has been running?
The model is over 10 years old. Yeah, so it's been trading in different products for more than 10 years. Okay.
And is it running pretty much the same as it originally did, or have you guys made adjustments over the years?
Well, obviously, it's if you take the strategy that went live, let's say in 2010, and the one that's trading live now, you'd see a big difference. But the philosophy is the same. Right.
So it was always a set of algorithms somewhere on the bench.
Exactly. Okay. The assembling methodology remains kind of our core.
Okay. And you guys have obviously found it to be effective. Otherwise, you would have made some other changes. So very interesting. So we do ask this question, and this is kind of an interesting time to ask because last year when I was talking to new strategy managers, we would spend a moment to ask about the democratization of hedge funds, and that it's quite new and different. And Carl's one of the only providers, actually the only provider at our levels. What do you think about the democratization of investments overall? And what I want to point out to investors is last year, democratization was blowing up. There was a lot of news, and the retail investors, as investors often talk about them, were really making big moves in markets and particular stocks. Basically, sometimes on tweets, I'll put it that way. But the market was often doing very well. And what we're seeing now is, the market it's a more challenging market. And how will retailer investors react now? It's a little different. So what do you think about this whole environment?
Well, I'm for the cause, right? I think democratizing any technology or any kind of way for people to manage their finances in a better way is good, right? And we believe in it. That's one of our core missions as well, is to democratize quantitative investment. So this is why one of the reasons why we saw Carl as an ideal partner for this. It's all about managing your expectations. If you're speaking to someone who's been in the market trading, let's say Tesla, crypto for a couple of years now, right? It's kind of hard to convince him that wait 10 years. We've seen downturns, we've seen all sorts of things going on. So I think my approach to this would be to really stress the importance of a risk managed investing model, right? This is why we call ours adjusted risk technology, right? Because there's another layer that we haven't even spoken about, which is about the risk management, automated risk management controls that we have before we trade. So we don't just trade left and right whenever we please. So I think that Carl is a good way to kind of spread your assets across multiple funds, multiple different strategies that take advantage of different market environments, right? But essentially, at the end of the day, the portfolio as a whole is stable because you're having so many sources of returns that are coming into it.
Right. So basically, I mean, we've heard this before. It's just a whole new opportunity of diversification, right? That most investors haven't had access to before. So spreading out that risk is always a good thing, and making sure you've got a lot of opportunity. So why don't you, I know we're talking about risk and everyone likes to hear about that too. It's a big part of hedge fund investing is that you are getting, the goal is to get better intended risk metrics on most hedge funds, a huge focus. So we usually have a whole session podcast where we might chat about that, and we may do that here as well. So, but why don't you give us just a high level 2-minute overview of the risk on Churfirsten?
Yep, no problem. So basically, our strategy is called, the original one is called adjusted risk technology, right? So we kind of spend a lot of our time focusing around all the different risks that can occur that could potentially harm our profits. So if you're looking at the algorithms, let's say we'll have more than 40 different models from which the algorithms are based. We would typically try not to overexpose ourselves to a single model, to a single instrument, to a single asset class too much. And we would have actually, we'll have limits put into place before trading that would automatically stop the trades if any of these limits are breached.
Great. Thanks so much for that. And I know our listeners would want to hear more about risk. So maybe we'll be able to chat again in another episode. But for now, I think we've got the basics of Churfirsten. And we always ask our new strategy managers, do you have any final words for our investors?
I would say that Carl offers now a great way to diversify some of your risks by investing into different managers, different strategies, different ideas. And I think that's the best way forward, especially now, as soon as the markets become a little bit more choppy. If you're looking at 2020, 2021, the everything bubble, hopefully it lasts for us all, but we have experience that says that it probably doesn't. So spread your risks and enjoy the ride.
I think, that is the most frequent advice we get at the end is diversify.
Do it at the end of the day.
Yeah.
What I say, not what I do.
Right. And it's great advice, and it's a big foundation for Carl as well. We believe in it too. So listeners, thank you so much for joining us today in another episode here. New strategy to the Carl Fund of Funds opportunities. Take a look, and thank you for tolerating my pronunciation of the lovely Churfirsten. I did my best, and we will see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.